I'm Trisha Peterson, a managing partner with Accord Group Holdings. Accord Group is a global merchant bank focused on the real estate private equity sector. I serve on the board of SPIRE and have been a member of SPIRE for a number of years. For those of you who are not familiar, just a quick note on SPIRE. In 2009, Stanford alumni recognized the opportunity to connect alumni, students, faculty, and staff to facilitate the sharing of real estate knowledge, ideas, and best practices. They founded Stanford Professionals in Real Estate. Today, SPIRE is the only real estate-related alumni club within Stanford, boasting a membership of more than 3,000 community members of Stanford alumni, students, faculty, staff, and friends of the university. While SPIRE is an official alumni club of Stanford, it is also an independent, not-for-profit entity. SPIRE is uniquely focused on supporting alumni professionals in the worlds of real estate and the built environment, affording opportunities and resources to students interested in the built environment, and encouraging Stanford University to develop a robust, multidisciplinary real estate education and research program. So for today's webinar, we're going to do some quick intros of our panelists, Emmy Adachi and Brian Kliksick. And then after they'll do a presentation, short presentations of kind of their views of the world. We'll do 30 minutes of kind of a moderated panel discussion and about 15 minutes of Q&A. So if you have any questions that come up during the discussions, please just post them on the Q&A section, and we have folks who will be moderate or calling those down for us, and kind of will answer those questions in the back 15 minutes of this session. So without further ado, today I'm pleased to introduce you to our two panelists who are both SPIRE members and also members of the Stanford Alumni Real Estate Council. Emmy Adachi is a managing director and co-head of global research at Heitman. She leads the North American and Asia Pacific research teams, overseeing strategy development and underwriting for all private equity and debt investments. She sits on the firm's North American Private Equity Investment Committee and Valuation Committee. Additionally, Emmy analyzes demographic and technological trends and their impact on real estate investment strategy and portfolio construction. She is a co-founder and board member of People of Color and Allies, POCA, one of Heitman's employee resource networks. Emmy received a BA with honors in urban studies from Stanford University. She is a member of ULI's Global Exchange Council and the NAIOP Chicago Board. Brian Kliksick is LaSalle's global head of research and strategy and is responsible for the firm's strategic outlook. He manages the global research team and oversees the investment risk, global quantitative, and climate strategy functions. He is editor-in-chief of LaSalle's Insight Strategy and Analysis Thought Leadership Suite and is a member of the Global Investment Committee and Global Management Committee. He also leads the expansion and enhancement of LaSalle's analytical tools and supports investor relations activities. Brian previously held various research and strategy leadership roles at Heitman in Hong Kong, London, and now in Chicago. Brian holds a BA with honors and distinction from Stanford and an MBA with high honors from the Booth School of Business at the University of Chicago. He is a member of ULI's Global Exchange Council and serves on the board of the Association of Foreign Investors in Real Estate, AFIRE. A fun fact about Emmy and Brian, and I hope I'm getting this right, they met as undergraduates at Stanford, where they were both pursuing their degrees in urban studies. Brian joined Heitman after he graduated in 2004, and when Emmy was graduating, a couple of years later, he encouraged her to join the Heitman research team. I hope I've got that all right. So they have worked together on the same research team for a number of years until maybe a couple of years ago or a few years ago when Brian transferred to LaSalle. So I think it'll be very interesting to hear kind of their maybe common and maybe divergent perspectives on the real estate environment and particularly given their kind of common backgrounds. So thank you, Brian, and thank you, Emmy. So as I mentioned, before we launch into the moderated panel discussion, we would like to invite Brian and Emmy to spend some time reviewing their big picture views of the market today. Brian will start with a broader view globally and of the regional markets, and we will have then Emmy kind of drill a little deeper into some of the asset sectors that they're taking a look at.
Thanks, Tricia. And you did get that right. Emmy and I we're close colleagues for many years. We're very close friends. Now we're competitors. We actually lived in the same dorm at Stanford where we bonded over our interest in the Chicago Cubs. But anyways, let me kick off with a few comments on where we see the world at LaSalle. I'm going to share my screen. Let's see if I can successfully do that. Can you all see that? I think that's working. So I hit the road every year in November, December, and then into the new year and talk about the outlook for the year. We call it the ISA outlook. And the theme of our 2025 outlook was the dawn of a new real estate cycle, a more upbeat view than we've had for a number of years as we've been, dealing with repricing and the impacts of that in real estate. But I'm increasingly getting the question, do you still stick by that positive view, given all of the noise, all of the things going on? So spoiler alert, we are sticking with the theme. We believe in the theme for a variety of reasons, which I'll hit on. But the world is certainly a more complicated place and a more complicated story than when we were first setting this theme back in September, October. So I'm going to try to, there we go. So the world in a slide, just a quick overview of kind of how we see conditions. It's different. It's a pretty, I don't know if bifurcated is the right word. It's divergent picture. On the macro side, you have a very strong U.S. economy. This question of whether cracks are forming around all of the uncertainty and the policy uncertainty of the current environment. We'll talk more about that during this session. By contrast, Europe has been rather soft. But in the last couple of weeks, the narrative has maybe shifted the other direction there as well, as big policy shift underway to invest more in defense, invest more in infrastructure, and sort of get Europe out of its doldrums. And that's not unrelated to some of the policy stuff going on with the global relations in the U.S. Well, I'm sure we'll talk about that. And Asia Pacific, as always, complicated, hard to characterize in one phrase. We call it trifurcated because you have Japan, which is the only major market where monetary policy is truly tightening. China, which is in a sort of generational economic weakness, and then you have the rest. But this story of strong U.S. economy, soft European economy is a little bit reversed when it comes to real estate fundamentals. We have a number of key sectors in the U.S., in particular, the long favored, post-COVID favored sectors of logistics and residential, where there's supply indigestion. So particularly in the Sun Belt, but there's this kind of year 1, 2, 3 underwriting question of just what is the path of rents and growth given the supply indigestion. The European picture, however, is a lot healthier. You just haven't had that wave of supply to quite the same extent in European property fundamentals. So even though the European economy has been soft, at least property fundamentals have been doing well, and you don't have the kind of the same degree of office challenges, for example, in Europe. And then in Asia, it's varied. Look, office fundamentals in Australia look like they do in North America, but maybe to a somewhat lesser degree of severity. But the office market in Seoul, South Korea, is actually one of the tightest property markets of any kind, let alone not just office market. So it's a very kind of broad range of conditions and property market fundamentals in Asia. And there's exceptions to these characterizations. The Spanish economy, for example, is one of the strongest of the major developed economies in the world. And of course, that it gets lost when you look at aggregates in Europe. But So there's always nuance to this. So where the kind of rubber hits the road for a lot of real estate here is how this shows up in bond yields, cost of capital. We prefer to look at nominal corporate bond yields. These are BAA corporate bonds or their equivalent. We sort of talk about those in building up our required return much more than government bond yields because they include an element of risk, which sort of approximates the real estate tenant base. And there have been a couple of big narrative shifts, in the last 6 months around this. Last summer, it was all about, what is the recession risk? Is it going up? Is it going down for the U.S. for the risk of a recession in the U.S.? Late last year, the narrative decisively turned towards a robust U.S. economy, risk of recession going down, U.S. pulling ahead of the rest of the world, and you saw these gaps open up. I don't know if you can see my cursor, but this line here is the kind of Eurozone bond yields, and that really opened up a big gap versus this darker blue for the U.S. And you had this backup in bond yields in the U.S. as the risk of recession was priced out. And that was supercharged a bit by the post-election narrative that this was going to be really good for the economy. We have maybe a bit, stickier inflation, but we'd have great growth. And some of the more extreme stuff that was said on the campaign trail wouldn't be the policy of the new administration. Now, of course, we've had a narrative shift after the inauguration, and as we've seen the policies being implemented, that a lot of what was said on the campaign trail was not just rhetoric, it was quite serious. And so in addition to that, it's been unpredictable. It's not, been a kind of smooth rollout of a lot of these policies. So, we've seen some of the more problematic stuff like entering into a trade war, but we have not yet seen some of the other things that could be economically positive around deregulation, lower taxes, and all of that. That takes time, that takes a Congress. And so in the last couple of weeks, the narrative shifted a bit again. You can see some, again, don't know if you can see my cursor, some big shifts here with, moderation in rates in the U.S., around a rising U.S. recession risk. And that has prompted a political reaction in Europe where they've really realized that they need to go it alone. They can't rely on the U.S. To drive the global economy, to drive their economies. They can't rely on the U.S. for defense. And so we've seen a big announcement in the German coalition, which is being formed to invest a lot more in defense and infrastructure. And that has shifted up bond yields in Europe, narrowed the gap quite a bit. And the growth picture is really significantly, potentially changed by this news. But this is fast moving stuff. So I said we were sticking to the narrative of New Dawn for real estate. Say, is it really a new dawn? Is it time to wake up or hit snooze? Look, I mentioned the stuff on the left. The nominal long rates have been sticky. This is not going to be a cap rate and bond yield compression-driven cycle. Policy, politics, geopolitics, a lot of noise, a lot of volatility and uncertainty driven by that. And transaction activity, while it's picked up in Q4, is still way off the levels of the pre-repricing. But on the positive side, investor sentiment is ticking up. Bid intensity, so number of bidders per deal. Our colleagues at JLL, which is our parent company, they use proprietary data from their capital markets team, and they're seeing much more vibrant bidding processes, more bidders, higher quality of bids because there's more pricing transparency, more clustered around expectations, narrowing bid-ask spreads. Debt availability. This has moved from a question of, is debt even available for certain types of assets or from certain lenders to just a question of pricing. CMBS is back, even small and medium-sized banks in the US are back. So debt availability has changed dramatically. And a big part of this is this sort of trio of pricing relativities. Repricing is largely complete, so prices have caught up with bond yields. Appraisals have caught up to a large extent with prices. Which opens up sellers who are unable or unwilling to transact below valuation and unlocks open-ended fund activity. Public and private real estate, so public real estate markets are no longer saying that we should expect a big continued repricing of private markets. They tend to be a predictor of what's happening in private markets. And maybe this is reversed a little bit recently with some of the issues in the broader equity markets, but the denominator effect has improved dramatically, meaning our investors are not seeing that they're over allocated to real estate, such as they did when before those valuations came down and before equities have had their big run, which seems to, at least for now, have come to an end. And then some positive things on the property market fundamentals. I mentioned oversupply. That's resolving. Starts are way down, which means that completions have peaked, et cetera. Attractive entry prices relative to replacement costs. So for us, just to summarize, three observations and three recommendations from those comments. It is the dawn of a new cycle, but we need to expect highest for longer. This is not likely to be a cap rate compression driven cycle. We need to focus on the cash potential, generation potential of the assets. Maybe if the economic environment softens a little bit with all of this policy uncertainty, that could potentially, allow yields to continue to ease a bit, but I wouldn't count on it. All this news, noise, and volatility. Look, we need to be careful in our strategies and focus on things that are anti-fragile, not sensitive to it. Things that are relate to global trade are going to be more exposed. Things that relate to services or tourism or education, things that are hard to slap a tariff on, those are going to be less exposed. Or maybe also seeking opportunities that stem from all this uncertainty. And the last thing I say, which I think will be a good transition as Emmy talks into Emmy, who's going to talk a little bit more about kind of the property markets in the US. The investment menu is complex again today. It used to, for the last 5 years, I feel like everyone just wanted sheds and beds. We're just going to order the usual. Today, retail is very much back on the menu as some of the strongest performing assets in our portfolio. Office is at the beginning of its recovery in the US, and it's further along in that recovery in Europe. But some of the key divides now are not between sectors. We're just going to pile into sheds and beds, but within sectors. So you need to kind of turn that value matrix 90 degrees and say, look at the quality differentials, look at the market differentials. Multifamily is overbuilt in the Sun Belt at the moment, and that's going to take some time to process. But that's not at all the case in a lot of gateway markets and suburban gateway markets, for example. So we make sense of that complex investment menu through fair value analysis, and that's all the more important with more sectors back on that menu. So with that, I'm going to turn it over to Emmy.
Thanks, Brian. So I'm going to hit on a few key themes, a little bit of overlap in the topics with Brian, and then we'll dig a little more into the property sectors. So my first bullet here, I've amended this to say new administration's policies expected to be pro-growth. And I put in the expected part because, again, as Brian alluded to, that was the expectation right after the election. There was a lot of optimism around this. So far, that's not what we've seen happen. It's still kind of the expectation if you think about the current period as being a fair amount of noise, that it's difficult to see through to what's really going to happen a bit longer term. But I will say it's certainly for those who were expecting real pro-growth policies from day one, that's been disappointing. And as Brian said, it's actually a lot harder to do some of these pro-growth things. You need Congress for a lot of them. It's been more difficult to do those constructive things than it has been to do some of the destructive things that have been going on. So we'll talk a little bit more about that, I'm sure, during our discussion. Even despite the weaker outlook, we're still seeing solid GDP growth in the forecast. So we use a forecast from Oxford Economics. They've lowered their 2025 GDP forecast from the high 2% to now to 2% for the year. So it's come down quite a bit. It's still positive. But yeah, so solid GDP growth, but not spectacular by any means. Inflation continuing to be sticky, as we know, despite the slightly more positive recent inflation print. Transaction volume, as Brian mentioned, it's been very, very sluggish ever since the peak years of 2021 and 22. It's been very slow. We did see a slight rebound in 2024, and we expect more of the same in 25, but it may not come roaring back. It depends on interest rates. It depends on the uncertainty and the volatility in the markets that we've been talking about. The good news is you've got uncertainty in the macro backdrop and you've got dislocation in the capital markets, but you have these property sectors that are generally still very healthy. And I'll talk about that more in a moment. Commodity office is the main exception to this statement. But in general, I feel very good about property fundamentals. And we believe it should be a pretty good year for most property operations, and that's going to help support values, and that's been helping to offset the impact of higher interest rates when we think about valuations. And finally, we believe that market dislocation presents opportunity. So we'll talk a bit about those opportunities. If we could flip to the next slide, please. Thank you. Here is an attempt, so there's a lot going on in this chart. This is an attempt to kind of figure out by sector, by property sector, what are some of the new administration's policies and how might they impact each property type? So in broad brush strokes, what I would say is deregulation and tax policy changes, as Brian said, those are expected to be pro-growth. We haven't seen a lot of that yet, but those are the policies that we're expected to juice conditions, make property operations stronger, give people more money in their pockets that they will hopefully be spending. So that's the positive side of the equation. The tariffs and immigration, as you can see in the middle, those are much more negative. So you're having, just the impact of tariffs on overall growth, on trade. You're seeing it, especially you see those red arrow, downward arrows in industrial and retail. So we're certainly seeing negatives there. And then you can kind of look at the bottom row at the net effect of all of these policies, and you can see we expected it to be somewhat of a positive. So you've got that kind of slight upward arrow in blue for residential and office, something of a negative for MOB, industrial, and retail, and neutral for student housing, self-storage, and senior housing. So those are some preliminary takes. Just keep in mind that ignores other things going on in those property types and is simply trying to isolate the impact of policies of the new administration. And then finally, I'll wrap up with a slide that's, I think, a good snapshot. If we can go to the next, yeah, thank you. A good snapshot of where the different property sectors are today. So if you move from left to right, we're essentially looking at the strongest sectors on the left. You have data centers doing incredibly well, single family rentals, student housing, manufactured housing, all going strong, some even gaining momentum. Second category, you've got a steady state sector like medical office, and then you've got sectors like retail and senior housing that are doing quite well after recovering from the COVID pandemic. Third category, you have sectors that absolutely were soaring sky high during the pandemic. They've come back down to earth. They've moderated in some cases because of too much supply, as Brian mentioned. But they're sectors we really have conviction in longer term. And then finally, you've got those facing headwinds, which would be commercial office and life sciences. And so with that, we can move into the discussion.
Great. Thank you. Thank you both. Sorry, there's a siren going right outside my window. So I think what was kind of, for me at least, interesting as a kind of starting point was how you guys are both looking at the macro environment, right? So in kind of Brian's slide, the world in a slide, which actually, Brian, the first time I saw your slide, I thought you meant that the world was in a kind of slide versus I'm summarizing the world in a single slide. But in your view, in the U.S., we're seeing it's still strong, but we're seeing some cracks. Emmy, in your view, it's still generally pro growth, but for people who are expecting it to be kind of this quick, growth environment, they're going to be a little disappointed. So with that in mind, Emmy, what do you think is kind of the time frame then for that growth to come in? We've talked about how some of these policy changes are going to take a while. Are we going to be seeing kind of a recession in the meantime? I mean, obviously, just what are your thoughts on that timing and what's going to happen between now and that growth period that we're waiting for?
Yeah, absolutely. So right now, I mean, if you're looking at some of the nowcast for GDP, I know people are talking about that potentially coming in negative in the first quarter. But as I said, in general, we haven't seen enough data yet. We haven't seen it come through in the hard data to say that we're heading into a recession. So right now, I think you've seen a number of the big banks have increased their risk of recession, but it's still typically below 50%. But there is a risk in the next 12 months. Um, but what I would say is right now, the forecasts we're looking at in our shop are saying, like I said, 2% growth in 2025. So that's okay. It's not the roaring ahead 3% or more that we thought we might see earlier on. But the forecasts actually get stronger when you get a little further out. So again, it's kind of taking the view that you're taking more near-term pain and there's going to be some longer term gain from some of these pro-growth policies coming through, so more in 2026 and 2027. So that's the kind of shape of the forecast curve that I've been seeing when I'm looking at the outlook. So again, I think it remains to be seen. There's a lot that we don't know yet, and the longer this uncertainty and volatility drags on, of course, the more damaging it can be to the economy and to confidence and sentiment. But in general, we are still kind of waiting to see if some of these longer term growth policies do boost the economy.
Yeah, I think it's a little like the comments around uncertainty damaging the economy are are really important to the outlook today. It's very common on conference stages in this industry or in economics in general to say uncertainty is super elevated today. And you become a little like Chicken Little saying, oh, there's just an era of uncertainty. I think that now it's time to say the sky is falling in a sense of uncertainty, and that this is actually a very unique environment for economic policy uncertainty. And that's really deleterious to growth. And much worse than, the impacts of the tariffs themselves is that we don't know, businesses don't know from day to day or even hour to hour. These tariffs are on, those tariffs are off. These tariffs are on, those are off. And the hope that there's a grand plan for this negotiation, I think is getting cloudier, that this may be just very reactive. So I think we should be careful about uh, in this environment of making predictions. This is bad for investment. I don't mean investment in real estate. I mean the I in this, C plus I plus G plus net trade. That's the components of GDP. That I is at risk in an environment where companies just don't know the terms of doing business, in terms of policy. I think my guess is that the administration will start to see that in the numbers. We're starting to get signs of that in some of the higher frequency indicators, and that's what these banks are using to increase their recession risk. And will, hopefully, um, have a sort of moderate approach and a more measured approach to policy announcements. That's the thing that I'm most worried about. I think otherwise I agree with Emmy's outlook completely, but this is, it's time to say that the uncertainty is a problem and is real and is different than prior times when we always would say on webinars and panels that uncertainty is a problem.
Right. But so Brian, you mentioned that, when you're talking about kind of this is a weakening or a threat to kind of the I in investment, but we are in a real estate panel, so kind of, and most of our audience is kind of real estate focused. So with respect to the real estate sector, if Emmy, you're telling us maybe 2026, 2027 is when we're going to see the growth coming, what happens between now and then for real estate?
Well, I would say that those are some of the periods when there's great opportunity to buy. If you're well capitalized, if you have high conviction, and you're buying for with a long-term perspective, you can often, get some great assets at pretty good pricing. There's a lot of capital out there waiting to be deployed. And again, if you can underwrite appropriately, so perhaps things are a little more subdued in your underwriting in year one. But if you really have conviction and believe things are going to ramp up in years 2 and beyond, I do think people should be thinking, from a lens of opportunity, because whenever there's market dislocation, that's when you find these great opportunities. I think that you're right, though. It could be that 2025 looks more like 24 and 23 in terms of transaction volume than it does 21 and 22. That's certainly pretty likely if people are spending the whole year with this level of uncertainty, right? Who knows when this is going to end? If that carries on, then certainly that's going to dampen activity.
One of the big positives for real estate through this should be higher replacement costs. Um, we're going to have immigration policies that reduce the labor force to, um, uh, construction workers, basically, which I think will have its biggest impact on the stick-built sectors, which have a large exposure to lower skilled labor and migrant labor. So we're talking about single-family homes and low-rise multifamily. Um, the tariffs, we're talking steel tariffs today, right? That is going to increase replacement costs. We already have in a lot of sectors, pricing does look attractive relative to replacement costs. Replacement costs, rents are higher than in-place rents. So even though we've had this wave of building that kind of was triggered, in the 2021 early COVID recovery, that's the rents are going to have to rebound even further to get building going again, which is going to drive cash flows and values. So that's maybe a silver lining in this for real estate specifically. I think that we're probably moving from a phase where the economic narrative of higher interest rates was uniquely bad, maybe not uniquely bad for real estate, but bad for real estate more than some other parts of the economy because we're an interest rate sensitive, leverage and intensive asset class. And to a period where a lot of these policies are bad for a lot of industries, and we are less in the front line of this economic regime, and there are ways that we will benefit in terms of, for example, this higher replacement cost narrative.
So what was interesting, I think one thing that's interesting for me on, at least when we're talking about residential or as in Amy, in one of your slides, you showed kind of residential kind of generally positive, right? So, and from a kind of a replacement cost, that should help with a supply issue. But how does the effect of kind of all the changes, immigration policy, kind of the deregulation, the kind of streamlining of jobs in DC and all that and elsewhere, how's that affecting multifamily demand? And how do you balance that against, okay, well, we'll have a better handle on supply, but on the other side of the equation, there's a weakness.
Yeah. Well, multifamily demand has been unbelievably resilient, right? So we've had record levels of new supply. And last year, despite that, it was outmatched by demand, by absorption. So you do have some countervailing factors when some of the things you mentioned, Tricia. So you've got, issues with immigration, which has driven almost all of our population growth in recent years. So you're going to have less population growth because of these immigration policies. That's going to impact broader demand. In general, deregulation and the tax cuts are expected to juice the economy broadly, and that's expected to flow through to consumers' wallets and allow them to pay more rent. If we have continued job growth, people are going to continue to rent apartments. What I think is compelling too for multifamily is simply that on the for sale housing market side, what you've got is not a lot of inventory, very incredibly high prices, incredibly high mortgage rates. So everything is working against people who really want to buy homes, and it's keeping them renting for longer. So we're seeing really low percentages of our tenants in our portfolio who are renting apartments moving out to buy homes. We're seeing that very, very low. We expect to continue to see that for a long time. The difference between the average monthly rent payment in an apartment and the average monthly home payment is huge right now. It's something in the order of 73%. That's massive. So I think there are some really strong tailwinds driving rented residential demand.
Um, so I think on this front, we had talked a little bit about transaction volume and kind of maybe what we'd seen in the last couple of years, and maybe that's loosening up. But and there's a lot of capital waiting in the sidelines, but no one's really kind of triggering kind of any buy. No one seems to be in a rush, I guess, is kind of what we're seeing. And how do you kind of reconcile the now's a really good buying opportunity, but why still so much money sitting on the sidelines?
I think that it's recognition of the fact that this won't be a cap rate compression driven cycle. The moments after the periods after repricing are always good vintages. But I think that we think that this one will be more subdued than after the GFC, the highish for longer environment. And so capital is seeing that they have time, but it doesn't take, uh, a dramatic fall in rates to drive a renewed activity in the market, with lenders back in, debt availability issues much better than they have been, with assets repriced, that is enough to unlock markets. We saw Q4 numbers come in to show a big improvement after a pretty weak earlier part of the year. Q4 is always a big year, but you look at it year over year, and it takes that seasonality out of it, and it still looks strong. Now, some of those deals were probably reflective of the fact that rates were lower in the beginning of that quarter before we had this run up in rates. But I think it's more importantly, it is the indication that we do see a kind of beginning of a new cycle in real estate. It won't take that kind of post GFC level of yield compression, rate compression to drive it. It has enough of a foundation to continue without that, but it'll be slower, and the magnitude of outperformance will be it will be more moderate.
Are you guys seeing this value correction happening right now, or I think we're seeing it slowly, and but it's not moving as quickly as it probably should be or could be doing. And I think there is also a difference between some markets, like the US is probably lagging behind some of the European markets. Can you guys speak to that? And more broadly, like how is that one of those things that is kind of like keeping folks from doing anything at the moment?
I would say that, oh, go ahead, Brian. I would say that in our view, the value correction is complete. And I think, that's on average, right? We think values are down about 19% from their 2022 peak. That's using the Green Street Commercial Property Price Index numbers. I think that, and I should note that when you look at it by sector, that same data series, you actually see there may have been some very large decreases in value, and many sectors have actually recovered those in 2024. They've recovered part of that value. So that gives us further confidence that we've bottomed out. Now, obviously, you did have issues with appraisal lags, and so you didn't always have valuations on the books reflecting the true value that you would get in the market. We've seen, as Brian mentioned, that some of that gap has closed. So I think with the exception of more commodity office buildings where you still might be catching a falling knife, right? If you're going to buy even at today's discounted prices, at least that would be our view. It does feel like you can feel a bit more confident in where valuations are today and feel like you can, move forward with your underwriting. So I think the value correction is complete, barring any major shock.
Is that the view at LaSalle as well, Brian?
In aggregate, that's the view. There's dispersion around that with some things that look a little expensive and things that actually look a bit cheap, and then areas like anything but the very top quality office where it's a little bit hard to say because they're still working on price discovery. So uh, in aggregate, that's accurate, but as usual, there's dispersion around that answer, and that's where strategy and outperformance comes, and that's where shops like mine and Emmy's need to try to be differentiated in those views. But I think in aggregate, the lag of repricing in private markets, that's largely complete, with bond yields of where they have been recently. Now they've been volatile, and that has impacts on investors' borrowing costs for leverage transactions, so that isn't helpful. But it's not necessary to. I don't think we need to expect a lot more repricing in the aggregate.
Interesting. Okay, that's good to know. I think that will kind of help people move off, right, and start transacting. And I think that's kind of been the issue for the longest time. It's just people just didn't know where things really stood. So kind of just maybe moving away from this kind of general vein of thought, we're seeing a lot of new capital. At least there's talk of new capital coming into the market from kind of your high net worth and kind of family office pockets of money. I don't know if those are things that you guys track, and curious as to your thoughts as to how that capital is looking, what their preferences are with respect to real estate investment, how they're looking at it, what's their view relative to your more traditional institutional investors.
Well, I'll just start off, and Brian, you probably have a lot to say on this. I think that there's a very long-term view taken, and what I've noticed that's interesting to me is that you're seeing a lot of these high net worth individuals and the family offices. They're often the ones who are buying up the distressed office buildings today, right? So clearly they think there's value there, that they're getting a great deal. Whether or not that's true, who knows? But again, they're taking a very long-term view.
And we have a product. We have an NAV REIT similar to the now much more famous, REIT that is from a company that starts with a B. So we know kind of a more granular universe of higher net worth people committing capital to real estate. And what we've seen is kind of a bifurcation in the mindset around investors who thought that this was going to be a sort of like a money market account, like a bank account where you could just put money in and take it out. And we know that in that universe of funds, there were redemptions as rates rose, and but there's also a large base of investors who view it for the long term, appreciate the consistent cash generation, are more educated on the kind of universe of properties that generate stable cash. So we've spent a lot of time making sure the financial advisors are aware of the qualities of sectors like medical office, self-storage, the not brochure quality assets that they thought they maybe used to think of when they thought of what made great commercial real estate, but things that are really good at generating cash. And so there's been a lot of, I think, stability in that once a subset of those investors, redeemed and realized that actually there is a liquidity that when things in private markets, liquidity is not constant, and they were going to have limitations on their liquidity in that universe of strategies. I think maybe in terms of investor sentiment, one that we're seeing today that needs to be real estate industry should focus on is and maybe worry about is less on the side of high net worth or individual investors, but the institutional investors' attitude towards real estate as it relates to other real assets and other private markets. And we've seen a lot of institutional investors shift from thinking about a real estate allocation to a real assets allocation and put infrastructure in there. We know that sectors of real estate some of them that look like infrastructure have performed quite very well. They've got great demand, and that sort of gray zone, that overlap zone, I'm talking about things like data centers, have been very hot. But I would put a broader caution out there that a lot of the presumptions about how infrastructure performs in the portfolio are based on there's not a lot of data that shows how it performs. Real estate has spent decades building up transparency and data around how the sector performs. And so now we know how real estate has done in a period of pretty intense interest rate adjustments and repricing. Infrastructure may look good because on paper, because we don't know the answer to that. So I think one thing that we need to do as real estate investors is, have a wholehearted defense of our sector, that transparency is a feature, not a bug, even though it shows these value declines over the last couple of years. And B, really think about a strategy in those sectors where infrastructure and real estate overlap, because there's a lot of interesting stuff to do there. But fundamentally, that is a challenge that we're facing, is this sort of broadening of real estate into real assets. And we think that there's presumptions being made without the data to back it up that we now have in our much more institutional, transparent real estate sector.
That's an interesting way to look at it, because I think people have historically thought of real estate as kind of your fixed income alternative, but with some upside. But we haven't really seen that more recently, and I don't really follow infrastructure, so I'm not sure how the infrastructure sector is faring relative to real estate in this current market environment. Do you guys have a thought? Do you guys track that at all?
Well, we're a pure real estate player at the moment. I think Heitman is too. There are sectors in real estate that look more like infrastructure but are still real estate. Those have been doing very well. I think it is I think there's a lot of exuberance without as much data to back it up as we now have in real estate. So one of the challenges in private markets is always having the data, and it's always unfortunate when an asset class or a corner of the capital markets is penalized for transparency. We see that in REITs, listed real estate. I think that listed real estate is a very attractive way to invest in real estate. But the capital markets have penalized it in capital raising over recent years, because the measured volatility, you can open up a screen on your computer and see that volatility, whereas we can't do that in private real estate, even though we know that there is underlying volatility there as expectations change. And so I think we should try hard to not penalize sectors for transparency. And I think private real estate, which is better at transparency than infra, is being penalized for that transparency today. And that is part of the exuberance behind this kind of other parts of real assets, which we've seen recently.
And okay, and we're going to launch into our Q&A in a second, but then I was thinking, Brian, kind of just taking that note about not having as much information around some of this newer sectors or infrastructure. Is this also, you think, why there's a little bit more exuberance around the alternative real estate sectors? What people will call alternatives, like self-storage and medical office and all that? Or are we really seeing better growth prospects in some of these areas or better risk-adjusted returns? And I know, Emmy, you spent some time kind of picking and choosing, or kind of pointing to which ones were better than other, but is that lack of long-term data also part of that? What's
I would say in some sectors, maybe we're seeing sectors like industrial outdoor storage are really buzzy, and it's kind of difficult to get your hands, on a true data set there. There are ways you can approximate it, but we have much better data now for something like self-storage than we had 10 years ago, much better. And so I would say in many ways, to the extent that it's gotten to the point where NACREIF, the institutional benchmark, has now included an expanded NPI plus that includes life sciences, self-storage, medical office, student and senior housing, all of these sectors, because they have enough performance data now to do that. So I will say that in many cases, we can actually back it up with true performance data, whether it's from the industry, from a third party, from our own portfolios. So I think with that improvement in data availability, that's also just a reflection of how much many of these alternative sectors have matured, right? And so now it is possible to actually get data and to so in many ways, I think the exuberance, around the alternatives is completely warranted. It's simply because they have been among the stronger performers. The alternative sectors in the NPI Plus have outperformed the benchmark and most of the conventional sectors over multiple time periods. So yeah, I think it's a little bit different when we're talking about the alternatives.
I 100% agree. 100% agree. I think the data, first of all, it's as Emmy said, a misconception that these sectors don't have good data. The data is different because the sectors are different, but it's really evolved since they emerged. Many of them have proven that they have more core-like cash flows than sectors that were the origins of core real estate, like conventional office, because smoother capbacks, less the demand drivers have a lower beta to the broader economy. I would say, though, caution against painting all of these sectors with a broad brush. Just because something's a niche sector doesn't mean that it's great. And I said earlier in my remarks that there's a broad investment menu, and we have to really dig into the relative and attractive value on each of those. So, for example, we are quite cautious on US student housing, and we're quite bullish on European student housing because of unique characteristics of those markets. We are bullish on iOS. I know Emmy said it was buzzy. We like it because it has similar demand drivers to logistics, but different supply drivers. Basically, you're not making much more of it because urban planners don't tend to want these like ugly parking lots of trailers, is what they perceive, even though the reality is often better than that. So you have to pick and choose, but we have the data to be good at picking and choosing. So I agree with them. I would agree with Emmy, subject to that caveat of just being selective and getting those calls right.
Okay, well, thank you both on kind of for answering all the tough questions coming your way. We do have a couple more that folks brought up on the Q&A, and I'll bring a couple of them up. I think, Emmy, there was a question around in your presentation. You had residential faring well in the current policy environment. Maybe trying to understand how single family residential still going strong. I think you did touch on this a little bit already, but
Sure.
maybe you could spend a little bit more time.
Yeah, the story behind single family rental is really about demographics and life changes, right? So there's a very large millennial cohort, which is our cohort, which is it has aged into the prime years for starting families and typically would be buying homes if they could. And so with that large cohort in their 30s and early 40s, and then with the challenges in the for sale housing market that I mentioned earlier, it's really becoming such an issue for people to be able to buy homes. But many of them still want to make some of those big life changes, like having kids. And so a single family rental, affords you that same lifestyle, but it allows you, it's the monthly cost difference between renting an entry-level single-family home and buying one is about 43% today. So it's substantial, and just a few years ago it was zero. It was about roughly equal. So you can see how much things have changed. So I believe that you're going to continue to see very strong tailwinds just coming from these demographic and structural factors.
Great, thanks, Emmy. Another question that came up that seems interesting and has broad, I think, applicability for this session. So I'm just going to bring it up here. Is there a concern that as the overall economy increasingly becomes digitized, our overall need for real estate is substantially declining? With e-commerce taking share from bricks and mortar retail, employees not wanting to go to the office, Zoom reducing the need for business travel. Um, what are our thoughts? Is there something bigger going on here?
Um, there's definitely a bunch of things going on that drive trends within real estate and winners and losers and changing dynamics. But I mean, at the risk of saying having a somewhat flippant but also nerdy response to that, we're like corporeal beings. We exist in space. Like we're not going into the metaverse. We have found that in-person interaction, in work, live, and play is real. We want to go places. We want to see people. We want to socialize. We want to collaborate. All that stuff is real. Travel is leisure travel has increased as a share of the total business, the total pie of the travel industry in terms of airlines and hotels. Sure, that's a function of some of the technological changes that are enabling people to collaborate a little bit better virtually. But I don't think that we're not seeing a kind of virtualization of the economy en masse. We're seeing these changes on the margin, shifting demand within real estate sectors, and that's what we need to get ahead of.
Yeah, I agree. It's just shifting from one to another. So as your example and the question of e-commerce, right? It created need for tons more warehouses. And then at the same time, people, retailers found that omni-channel models work best, and they actually need their physical stores too. They need both. And many of them are actually doing their fulfillment out of the physical stores now. So there's still this, again, as Brian said, we're still physical beings. There are still physical goods being moved. And so but there are shifts between the winners and losers. So you've had, a shift now. People are spending more time working at home. That means they might need larger units, and then you might need smaller offices. But at the same time, again, we're seeing return to office, right, being a pretty major trend this year. So there's always kind of these pendulum swings, I would say.
And I'd commend SPIRE for getting a couple hundred people to sign up for a webinar because this is one of the best attended webinars that I've seen in a while because people have webinar fatigue because they feel like they get a lot more by going somewhere in person and socializing over coffee and before and after. I think a lot of the 2020 predictions of all the changes from COVID that would shape real estate, most of them were far less important than the financial market implications of COVID of creating a wave of deflation that overcorrected it to a wave of inflation that caused a great repricing. The political polarization that came out of that tough period when people were really frustrated with their lives that has contributed to a more volatile geopolitical and political environment. That stuff has proven way more important than we don't need offices, we don't need in-person meetings, we don't need to travel. We've seen big returns to all of those things. So maybe a lesson in not getting swept away with the narrative of the time and thinking further ahead as to what will really matter. I sure hope that we will feel the same way about that in a couple of years as we look back on 2025 and we're looking at all of these kind of reshaping of the global trade and political order, which is worrying a lot of people.
Mhm. So we're kind of on time. We're at 10 o'clock. I want to thank both Brian and Emmy for their time here. We had a lot of questions that came through that we're just not going to be able to get to. And I'm going to ask maybe Brian and Emmy, maybe there's a way for us to kind of consolidate some thoughts on that and share in a memo of sorts. I'm probably volunteering extra work for everybody, so maybe not doing that. But in any case, do you guys maybe some closing thoughts from Brian and Emmy about kind of, the outlook for real estate and how should people and how should investors be just prepping for the next few quarters?
Yeah, I think I'm feeling good about real estate. There are all kinds of issues out there, as we've discussed very thoroughly today. But again, when I come back to just the fundamentals of real estate itself and the way the various property sectors are looking, what the demand drivers are, I'm feeling good about it. So I think it's going to be hopefully a better year, right? We've had some tough years recently. Um, I'm still in the optimistic camp. Despite the recent events and turmoil in the markets, I still think that we're setting up for some good long-term performance, and I'm looking forward to, I think it's really exciting too, as we kind of talked about today, this Brian's expanded menu, right, of options. Today we don't just have the four main food groups. We have so many options that are all so interesting. The drivers behind them are fascinating. iOS is fascinating. All of these new types of housing that we're looking at. I'm very excited about the future of real estate and the way it's continued to broaden out. So yeah, that's keeping me optimistic.
I think I kind of delivered some thoughts accidentally that were probably serve well as concluding thoughts. But I agree with Emmy. I mean, this is a better moment despite all the noise and all the volatility. And I'm always a little bit afraid to look at the notifications that I get from the Financial Times app or the BBC News app or whatever. I'm a little afraid to look at the Economist every week and have another take that's going to throw me for a loop on where we're headed. But just putting all of that aside, we are in a better environment than we've been for a few years. And real estate is mature asset class with proven resilience of cash flows. It's also proven that financial theory around what happens when bond rates increase in a long duration interest rate sensitive sector. It's also proven that bad things happen when that happens, and but we can find a way to reprice and revalue and get the engines moving again, and that's what we're seeing today. So I agree with Emmy. I'm just watching that news and thinking about trying to separate the signal from the noise.
Great. Well, again, thank you very much, both of you, Emmy and Brian. I think this has been really interesting. And hopefully people are feeling a little more upbeat about where we go from here, and kind of and able to sift through all the noise and kind of figure out where to go next steps. So thank you. And thank you for all of you who are on the call and participating. And I guess that's it. Have a good rest of your day, and we'll hopefully see you at the next SPIRE webinar. Bye.